Welcome to CLIC Connect. I'm your host, Craig. We're in the tail end of season 10, and I've got a great first-time guest joining us, and we're going to be talking about not only hotels, but insurance, which I think is a subject that we really need to touch more on. So just a second, we're going to bring him out. But before we do that, I do want to thank our friends at Red Roof Franchising, Paul, Matt Hostetler, and the team over there. They'd love to talk to you. You know, they've got a soft brand. They've got their extended stay. They've got a new prototype on that. They're doing great with that across the country. Hey, they even won Deal of the Year at CLIC 8 recently. So give Matt a call. They'd love to talk to you. Don't forget about their world-famous economy brands as well. So without any further ado, I want to bring out Jackson Granstaff, National Hospitality Practice Leader at Verdis. Jackson, how are you?
Craig, I'm doing great. Thanks for having me on.
Hey, thank you for making the time. I have been preaching for years that insurance is something that we don't talk enough about. You guys are critical not only for the deal flow, but for the day-to-day operations. And sometimes you guys are the unsung heroes. Sometimes you're the GOAT. It kind of depends on where we're at in the financial cycle. But before we jump into all the questions, would you do me a favor and please tell the audience about yourself and your company?
100%. Absolutely. So Jackson Granstaff, practice leader for hospitality here at Verdis. Verdis was founded about 11 years ago with the idea that vertical specialization is the way of the future for the insurance brokerage marketplace. There's no longer necessarily room for your golf buddy at the country club to be doing your insurance if they're generalists. And the idea behind that is we're playing in the same markets every single day. We're only working with the insurance companies that want to do hospitality. I think a lot of people in the hospitality space think there's no markets that want to do insurance and hospitality, but that's simply not the case. So again, founded 11 years ago with vertical specialization in mind. Private equity, multifamily real estate were our first two verticals. We expanded to hospitality with a strategic partnership with Kimmons Wilson Insurance Group about 2.5 years ago. Kimmons Wilson started Holiday Inn and started an insurance company at the same time. So definitely a forward thinker, thinking about the potential challenges that would be facing his industry at that time, as well as what was going to be coming up in years since then. And so that's the space we play in. That's the only space my team and I play in, and it's a lot of fun. It gets pretty dynamic.
I agree with you, and I think that vertical integration is the key to success. I mean, I've done that when I was working for publicly held companies that made the transition over to just hospitality. And my feeling, and I'm prejudiced, I'll admit it, I think we've got the brightest and the best in the hospitality industry. Not only is it a cash business, it is also a real estate business. And, we're subject to a lot of different headwinds at times, but it's just a great industry. What is the state of the hospitality market right now?
Yeah.
Where do we stand with, property liability and emerging risks, from coast to coast?
Yeah, it's a good question because it's not unlike just hospitality in general as an industry. It's evolving at a rapid pace, an ever increasing pace. I think normally people think of insurance as something that's a little bit slower to keep up with maybe their industry or their risk. But it's constantly evolving. And I think part of that is AI. AI helps with those things, especially with our risk modeling and things of that nature, where we're able to look at thousands of data points rather than just a few data points to justify what should a premium spend be, how much is your risk, right? But from an overall market perspective, we've seen some interesting transitions over the last number of months and really over this last quarter. So one of the most interesting pieces is commercial property coverage has come down in rate kind of across the board, which is really exciting. We just finished a renewal on a program for 2 assets in Florida, one of them being very, very South Florida, very close to the water. And we saw about an 18% reduction in their overall property spend. So that's exciting to see. Now, not everybody's seeing those same results. There's a lot of things that go into that. But from the other end of the spectrum, from a liability perspective, I mean, hospitality is getting hit pretty hard. It's being looked at a lot closer, a lot more fine-tooth combing in the underwriting process. So It's all about, getting into the market the right way and really painting yourself in the best possible picture to the underwriters, because they're being very selective.
I would imagine they have to be. And I think, every state in the union has had some sort of natural disaster. Fires here, hurricanes, tornadoes, floods, mudslides, so on and so forth. So how are these rates coming down with every state in the union being affected by this? And whether you're a believer in climate change or not, we've got weather patterns that have changed. And, predicting the future, I mean, AI is certainly going to be a large part of what you guys have to do, not only today, but in the future.
Certainly. And you're exactly right. I mean, you look at in 2024, every single state in the union, like you said, experienced at least $1 billion cat loss. So weather related, effectively, loss event. And that's huge. And I think, what needs to be at the fore is the understanding that this is probably not slowing down, at least not in the foreseeable future. We anticipate that these losses will continue to increase. And the frequency, not only the values, continue to increase. But when you think about how are rates actually coming down from a property perspective, it's kind of dynamic. It's pretty unique. But the insurance marketplace has been increasing rates. They're for-profit businesses, right? They've been increasing rates to account for what they're predicting as potential cat losses in the next year. So all of the reinsurance, the insurance that the insurance companies are purchasing, is being priced at a certain level. And they're pricing it based on, we think we're going to have a few hurricanes and hitting, a big portion of Florida, whatever it might be on the East Coast, that's going to amount to a certain level of risk, a certain level of loss. Wildfires, way harder to predict, but we know that they're happening. We know where the climate is. We know where, they're even testing soil density, things like that. But what happened is we had two pretty significant hurricanes domestically last year, and the total loss, and all of these are still in estimation phase, was lower than what was anticipated from the rate inflation environment. So part of that is, the somewhat tragic note of a lot of the people that were suffering property damage were not insured, right? A lot of people were in the Carolinas, et cetera. There was no flood insurance. So the huge negative there is there's no coverage for them. The positive, simply from a dollars and cents perspective, is it didn't impact insurance.
Right. Wow. I mean, now personally and professionally, I believe in overinsurance. Okay. Flood, earthquake, fire, homeowners, everything you can think, public liability for the hotels, everything you can think of. What about disruption of business? I mean, that's got to have kicked up. Am I right on that?
Yeah, absolutely. Yep, absolutely. And I think, one of the challenges that insureds face, business owners face, is proving what that disruption is. I mean, there's very standard ways of doing so. Every carrier is going to use a business interruption worksheet and calculation. But ultimately, it's all in how you prove exactly what the disruption was, exactly to what level, the perfect time parameters and everything that goes into that. The data capture is so important. And that falls first and foremost on the owners. But right next to them, that falls on the broker. The broker has to be a bulldog with that data. Everything has to be captured in real time to be able to recoup appropriately.
Yeah, I would imagine top to bottom, everybody that you're working with inside your firm and with the insurance carriers itself are, working a whole lot of hours right now, getting all this data, sifting through it, coming up with game plans for, not just the next 6 months, but the next 5 years and beyond. Sure. Well, and don't take this the wrong way. I mean, bankers do this as well. It's a belt and suspenders business. It's data driven. Okay, so those projections for the next 5 years, are critical. And what's the response team? You guys have got to be seeing some issues with competent to skilled labor, besides materials, to rebuild these assets and get them operational. Isn't that also having a negative impact on the disruption?
Absolutely. And even just boiling it down to the cost of materials. And we watch things as granular as, and maybe really, I should say, macro as tariffs, right? But we're looking at everything that goes into the cost structure, any of the cost centers of operating your business or getting your business back to operation after a loss event. But the hospitality industry is subject to major valuation increases from the eyes of the underwriting community. And there are ways to combat that appropriately and keeping the limits at an appropriate level. But a lot of it is very accurate. It's just, like you said, the cost of labor to actually get skilled labor out on site in a reasonable time frame and get the materials, everything is going up. So, having those preferred providers and having an understanding of their risk aversion, the way that they cover themselves, all of that plays into the overall cost of what the owner of any given hospitality entity is going to face.
Absolutely. Let's touch on wealth protection versus cost cutting. Understanding when risk management is an investment and not an expense. Because I think that question is framed the right way. You and I both know owners that, it's like, oh my God, this cost is elevating and elevating. I've got to look at ways of cutting it. And that may not be the best route to take.
You're exactly right. I think there are two somewhat binary and polarized perspectives, both of them valid, but there are two different perspectives to this, which is I want to cut my costs as much as possible. And in the event that my insurance is not adequate, at least I've saved some of that money in the bank and I can make it work for me. The other end of the spectrum is, okay, well, you can still do that. Right? You can still cut your actual raw premium spend dramatically, but do it in a strategic way that is a wealth preservation perspective. And that's what we focus on that. I love that term, but we focus on that constantly. But it's the idea that we're going to take responsible risk the way we want to take risk, rather than try to cut our cost and then have the carriers reduce our coverage in the background to where we don't know where we're exposed. So we want it to be, the wealth preservation tactic is so important because it's an idea of what are you comfortable with taking on as risk? How do we ultimately use those dollars to protect you in the future? You keep them in the bank, it's your money. But how do you use those dollars to protect you in the future if the worst case scenario does happen? Your insurance is going to respond the way you know it will. But you also, depending on the structure of your policy, you might fund for those potential losses that you're comfortable with retaining.
Love it. Hotel owners, how can they take control? You got a continuum of risk from fully insured to captive self-insurance. Now, I think the self-insurance side is a huge risk, not one that I'm willing to bet on. Okay.
Yeah, it's a math equation. And I love the way our CEO talks about this the same way, but it's just a math equation. It's as simple as that. You can trade X number of dollars in premium spend for X number of dollars in coverage and limits, whether it be liability or property, does not matter. Or you can look at it from a different perspective of, I've got this money that I feel comfortable with allocating to this, my total cost of risk, which is your premiums and your claims costs that would be under a deductible and things of that nature. There's a few more factors that go into that, but it's looking at that equation, having somebody advise you and consult you on the fact that this is how you've been doing it. This is a different approach to it, looking at a menu of options to see this risk continuum take place and understanding what works best for my business. There's no off-the-shelf product that works for any given hospitality company nowadays. Everybody's so dynamic, everybody's so diverse, and which is great. That's what's great for the industry. That's why the industry is so resilient. But that also demands, very unique and dynamic approaches. You can't have one without the other from the insurance perspective.
I agree. And there's a drastic difference between select service, extended stay, full service, destination resort. And nobody likes to slip and fall. Okay. Nobody. But your odds on that happening at a full service or destination resort, up the ante dramatically.
Sure.
It's like, how much does education play in your process with the owner? That's actually where I'm trying to lead you to.
Oh, it's huge.
Because I think you've got to have annual inspections. You've got to update everything. You've got to take those recommendations seriously. I don't care if it's painting a yellow stripe on something so that people see it, or if you've got a drainage problem at the pool that your inspector sees that, it's got to be taken care of. So what's that like?
Yeah, the education piece is huge, and something that you are definitely not unfamiliar with. Turnover is huge in the hospitality industry, but I'm going to go from the lowest level up, right? But education from our frontline employees, or education to our frontline employees, rather, is so important, and it becomes more and more of a challenge because we have so much turnover. And that's not only hospitality; that's a lot of different industries. Hospitality is definitely a victim of that, though, and as every one of our clients, of course, is different, but the willingness to allow us to be extremely hands-on and put together these training programs and use different resources that make it just seamless, not unlike the way that you and I are interacting right now. Absolute seamless training, understanding what are the best practices, what are the incident response best practices as well. So if something does happen, if you do have a guest slip and fall, if you have somebody get injured in the pool, in their bathroom, whatever it might be, there is an appropriate incident response, which ultimately will lead you to the lowest possible claim value that's going to be either out of pocket or covered by your insurance. So that it starts all the way at the frontline employees, the people that are in the nitty gritty all the time, and it goes up the chain, because when you talk about actually protecting the properties and having these incident responses to wildfire events, hurricane events, et cetera, that's more about that management level, and you have to have a plan in place. You have to, and there's coverages out there for incident response, things of that nature, but you have to have a plan in place, because if you can show the insurance marketplace that you have these plans, we're trained on them, we revisit them on a regular basis, they're compliant, you're a beautiful risk to the insurance marketplace, and they're going to want to write you, and they're going to want to do it at a more competitive price.
Love it. Let's talk a minute about building an insurance strategy for sustainable growth. I mean, you've got to structure your programs, scale with your portfolio. Okay. Everybody wants to expand their portfolio. So how are those dynamics changing? I mean, is it getting to a point where you're thinking that somebody's portfolio may be a little bit too heavy in the Southeast and not enough Midwest or the West or the Southwest, island states and territories? How are you building that insurance strategy?
Yeah, and there's a wide array of different levers to pull in these situations, and we look at it from a couple of different angles. We work with management companies that have huge Southeast, or someone referred to it as the chin of the country. Southeast over through Texas, et cetera, and up through California. And they will diversify ultimately that premium spend and that risk from the insurer's perspective by having their assets that are maybe more central, Midwest, et cetera, insured on the same program. The opposite can be true. It just kind of depends, right? You can either do a bifurcation of these exposures, or you can combine them to ultimately compress the rate as much as possible. But the idea of setting up for portfolio growth or attrition, because both are very important. If your plan is divestiture, you need to be set up for that as well. It makes it more attractive. But from the growth perspective specifically, it is having the policy language that is built for people who are trying to continue to expand. And whether that be automatic additions for a certain period of time or a certain dollar value of the property, or it be pieces on the general liability, different endorsements, et cetera, that allow you to add different mortgagees, lessees, things like that. Things that become so important in the event that you actually do get that next portfolio, start a development project, whatever it might be. It has to be thought of ahead of time. If it's thought of as an afterthought, you're going to be spending whatever you're beholden to.
Yeah. And that's a frightening thought, just to be, realistic. Sure. That is frightening. So I think, I've always been one, and I've learned this from clients in the past, that you start looking at your insurance policies against 6 months prior to the renewal. engage with your underwriters, engage with your agent. You start looking at, okay, what's been the scenario in California, if that's where you're heavy, or Arizona, or whatever state it is. Start looking at that ahead of time. And you've got to be the trusted advisor for whether it's a management company or an ownership group, and participate. These guys have got to be part of your team, everyone. Trust me on that. It's the acquisition and disposition of assets is normal, as you mentioned earlier. So let's talk about transaction ready insurance.
Mm-hmm.
I know when various companies are going out there and combing areas and looking for growth, it's always a good idea to talk to your insurance carrier on the front end, because they're dialed into certain idiosyncrasies in that region. So how about that? How about transaction ready insurance? Optimizing coverage for acquisitions, dispositions, and post diversity continually.
Sure, absolutely. And it's a great question. And it plays back a little bit into our wealth preservation versus cost cutting conversation, because there are certain things that might show up on your policy if you're more of the cost cutting mindset. And again, I understand that mindset. It's very respectable. But if you're of that cost cutting mindset, the carrier knows, hey, I know how to cut their costs. I'm going to exclude X, Y, and Z. That, in the event that you want to either sell an asset or at least transfer the asset, maybe not the stock, et cetera, if they're inheriting any portion of that insurance program, or if you're bringing on investors into the same asset, they're going to see these things as red flags. And those red flags can kill deals. There's no question about it. Now, if it's a total transfer of the asset to whole new ownership, it's a different story. That's going to be their insurance at that point. But again, it all comes down to how have you been purchasing your risk transfer one way or another, because that will always set the stage for how the next person's going to be purchasing it. These carriers, especially with these higher end assets, especially in California, these carriers have seen submissions for these properties before. They simply have, or they have friends in the industry who have, so they know where it's been priced, and they're going to use that as a benchmark. That doesn't mean they're not going to beat it. That doesn't mean they're not going to exceed it, but it's going to be used as a benchmark. So it's very important to have great control of that, especially if it's an asset that you intend to remove from your portfolio.
Yeah, or it's a long-term hold and you're building generational wealth. I mean,
sure,
it's that baseline. I think you touched on something that a lot of people aren't really thinking of, and they should. It's let's look at this at the long-term hold. Do we have an asset that's suffering and we have to have an injection of capital into it? Are we diluting the stock in that particular one, and sending up all types of red flags, not only to our lender but to the insurance carrier as well. But I like that being active and getting in the middle of that, or at the beginning stage of whether you're selling or you're buying or both. I think it's absolutely critical at this point in time. Before we go into our lightning round, I wanted to ask you one more question. Mm-hmm. And how involved are you with the lenders? Are you seeing more requirements from the lenders that are also, ratcheting up the fees and everything, for the borrower in the long run?
Absolutely. We have more interaction with lenders now than we have in prior years. That is certainly true. And it's especially in places like California, like Florida, the places that you think of when you think potentially catastrophic risk, where we're trying to require a certain amount of insurance, because as a lender, I need to be made whole in a poor situation. But the one of the confluences of technology and conversation with lenders is the fact that we can actually talk. We can have an educated talk track with lenders to say, yes, we can go out and procure that much insurance, and it will be at an astronomical cost, whatever it might be. Let's say flood, or let's say wildfire, et cetera, that goes all the way up to the full value of the building. We can do that. It's going to be at a huge cost to us, or we can use our modeling and we can judge based on burn scars in California, based on the natural protections that we have around our environment or our property, or even just looking as granular as here's the footprint of our parking lot around our property. This makes us X% less likely to have, fire risk actually impact us. So we look at everything from a modeling perspective. We have to. Not everybody's doing that. It's very important to do it. And what it does for you is allows you a seat at the table to actually negotiate with that lender from an insurance requirement perspective. And we've been successful. I think more and more lenders are becoming comfortable with alternative risk solutions, as well as more of these wealth preservation strategies that we talk about, which is controlling our cost, doing it responsibly, and setting ourselves up for success where we're not just bleeding money into premium spend.
I agree, and I like that point of view and the way that you're looking at it, and I think that strengthens the partnership between the owner, the management, lender, and the insurance carrier and agent. And I think that's a more realistic way of looking at the approach to your insurance needs and requirements. Yeah, I like that a lot. Okay, my friend, are you ready to play our lightning round?
I'm as ready as I ever will be.
Okay, producer Danny's going to put 2 minutes on the clock starting now. It's just word association. Favorite sport?
Basketball.
Corvette or Porsche?
Porsche.
Nice. Interest rates?
High.
Backgammon or chess?
Chess.
Social media?
Facebook.
Okay. Aisle or window?
Aisle.
Favorite airline?
Southwest.
Nice. We get anywhere with that airline.
I'm a Kansas City guy.
There you go. Reward points?
A-list preferred.
No. Uber or rental car?
Rental car.
Favorite restaurant in your city?
Oklahoma Joe's.
Nice. Best vacation location, hotel or resort?
Boy. Vacation location, I've got to go with Cabo.
Okay. That works, and you did that with 47 seconds left. Very good, Jackson. I appreciate that. We've touched on a lot today, and I definitely inviting you back to do a deeper dive on some of these subjects. This is a great show today. Thank you very much. What one thing do you want our audience to know about you and your company?
Yeah, and I appreciate that, Craig, and thank you for having me on. This was a lot of fun, first and foremost, and I just really appreciate the opportunity to speak with you. And I think the one thing I want people to know about Verdis is, and really the insurance brokerage space in general, is think of your insurance brokerage as a consultant. Don't think about them as somebody who's going to go transact on something for you. If you think of it that way, you're going to get the same results, and it's not going to end up well, and you're setting yourself up for that continuum of increase in cost. But Verdis is a consultant first. That's where we focus. And again, in the hospitality space, we have a ton of fun doing it, but it's all we do, right? This is the only place we focus in. So if you are having these same issues that so many are facing in hospitality insurance, give us a call. This is what we do, and we'll find a different way.
There we go. Okay, so my last question is, how can people contact you, Jackson?
You can find me on LinkedIn all the time. I'm always bugging people on LinkedIn. Otherwise, phone or email, which Craig, I'll provide to you as well.
Yeah. You want to tell them?
Sure.
Yeah.
You can call me anytime at 913-226-7865. Over email, it's jgrandstaff@verdisins.com.
There we go. Jackson, great show. You're welcome back anytime. And if you have an update on something insurance related to hospitality, give me a call and we'll get you on the show even quicker. Also, you've got an opportunity if you want to write articles for the CLIC blog. I encourage you to do that as well, and we'd welcome them. My friend, thank you so much for joining the conversation today. Have a good one.
Appreciate it.
Thank you, our audience. Great show. Give Jackson a call. He'd love to hear from you. Few things before we wrap this up. I want to thank everybody who attended CLIC 8 and all of our sponsors, exhibitors, and speakers. I think it was our best produced conference yet. So thank you all for that. Stay tuned. We've got some big announcements coming. And also, if you could, please go to our YouTube channel and our social media channels and follow us, subscribe, ring the bells if you need to. Don't forget about 3-Minute Thursdays with Glenn Hausman and I on Instagram only, and also our Friday night audit show. I'd also like to thank our production partner. Red Roof Franchising makes this show possible. Thank you, Matt Hostetler and the team over at Red Roof. Give Matt a call. Let him know that producer Danny and I sent you. They'd love to talk to you about joining their franchise family. They're on a growth mode. They're doing some really great things over there. So give Matt a call, please. Also, look for me at Beat the Money 2025. We'll be doing interviews live from Jim Butler and JMBM's Meet the Money conference coming up in May. So stay tuned for that. And as I'm fond of saying, be kind, share your knowledge, go be amazing.